Welcome back to this special live broadcast of the IDC Dialogues, where we're focusing our discussion on the recent announcement of the establishment of a BRICS-led development bank. Joining us now from our bureau in Nairobi, I have George Bodo. He's head of the financials desk at EcoBank Research. George, thanks so much for joining our conversation. We've gotten a lot of perspective from this end and views on the establishment of this BRICS Development Bank. It's been loosely characterized as an IMF and a World Bank rival. Let's get your sense of the kind of sentiment over in Kenya right now around the establishment of this bank and the viability of it in the long run.
I think it's a more viable project, and it makes a lot of sense. And I tell you what, in Africa generally, there is a general lack of long-term funding, especially towards infrastructure projects. And I tell you that, for example, in Kenya, 80% or 90%, about actually exactly 2012, in 2012 alone, 90% of the deposit resources in the banking sector alone had a contractual life of, let's say, 12 months, under 12 months. And you're looking at long-term infrastructural projects of between 15 to 20 years. Certainly, there is a huge funding gap in the long-term developmental projects. So on that note, I think a BRICS-led development bank makes a lot more sense.
If we're looking at the funding and, this leads us to the viability of this bank and achieving the kind of outcomes that it's tabled so far, George, funding for infrastructure projects worth $4.5 trillion. That's where we stand at this stage of the game. We had the World Bank coming in with $52.6 billion in loans, grants and equity investments and guarantees in 2012 alone. Do you think that this bank is going to have the financial muscle it needs to target the problem areas that you've highlighted?
I think for a start, it will be resource constrained. And I can tell you that even currently, the African Development Bank is really overstretched. They've only been able to disburse about $40 billion between 1967 until 2011. In 2011 alone, they disbursed about $3 billion. And I can tell you that in 2009, at the heart of the global financial crisis, the demand was outrageous. The African Development Bank disbursed about $8 billion, which is about 128% year-on-year increase. To answer your question, I think initially they will be resource constrained. They might not be able to meet the demands of the development projects that are especially in Africa. And even some of those BRIC members, the bigger BRIC members, for example, India has in excess of $1 trillion infrastructure funding gap. So it also brings an aspect of resource content. It will be resource content initially, but I think going forward, they will be able to catch up.
TB, as you highlighted, though, we are at the foundation stage here, so we can't be too critical. We've got the building blocks being established, and what we have established is the gap is there, the need is there, the demand is there, and that turns us to the next chapter, criteria for these loans. I mean, we had the Secretary General of the OECD saying an important consideration will be the new bank's criteria for loans or conditionality. Will it lend at market rates, and what policy conditionality will be attached to those loans at the end of the day? How do you see things playing out in that regard?
Look, just picking up on what my colleague was saying, let me just touch on this. There's a point that Lumkile mentioned earlier on during the conversation, and that is the capital markets across the continent or even beyond. I think we shouldn't believe that the commercial bank market, as well as the development finance institutions, including the BRICS bank, by themselves will be adequate to provide the kind of capital that is required to undertake development at scale on the continent or even across all emerging markets. Lumkile was absolutely right. You are going to need governance, you are going to need the kind of economic policy environments that will enable private capital, be it in high net worth individuals or collective schemes like insurances and asset managers who are managing money on behalf of large pools of investors to enable those to be part of the investment program across the continent. Otherwise, the DFIs alone will not be able to pull it off. As the colleague is saying, there are balance sheet constraints that we will all face at some point, given the kind of quantums that we are talking about. So that's what I would say. The institution, from a design point of view, I would like to see a couple of things. One is that from a policy support perspective to countries, it shouldn't seek to be prescriptive and dictate. They have to employ the kind of professionals who can persuade and undertake changes to, or help countries undertake changes to their economic and fiscal and macro policies in a manner that is acceptable to themselves. Because come to think about it, any initiatives of a development nature really, in our experience, don't take root unless they are acceptable to those who are participants in such development initiatives. So yes, it has to provide policy support, institutional development support to strengthen institutions. I mean, it is very common that many of the institutions across the continent, I think so in other emerging countries, really are weak institutionally, not only financially, but in terms of skill sets, in terms of operating systems, and so on and so on. So money alone will not be enough.
Yeah.
And so in the second instance, this particular institution will have to provide a lot of risk capital, a lot of early stage support in order to bring projects to realization, one way or the other. That kind of early stage risk capital finance has to be factored into the design of the institution.
Well, we've seen everyone shaking their head, nodding, and in agreement there. Lumkile, you're pretty vociferous there. Just take us through your thought, because you're pretty much in agreement with what TP is saying.
Yes. I think one of the most innovative areas that we've seen is what rich people are doing, whether it's the Bill Gates Foundation that's targeting particular problems in the continent, but also others with the development of social entrepreneurship. There's a lot of money. I know Holland does a lot of work around social entrepreneurship, where they're targeting social sector, which typically will think is a government role to support, but innovatively is provided by the private sector. So there's a lot of that money which we don't talk about, which we don't see at all, because private sector driven and it's playing a huge role there. So I think really the issue for me is going to be the longevity of economic policy. Because we've seen, I mean, in a country like South Africa, despite the dominance of the African National Congress, the song changes every time. So we hope that in a country like South Africa, that the National Development Plan becomes the core of a long-term agenda. Similarly, if we go to Mozambique, we will expect the same, because without a long-term economic policy, it just creates problems for pension funds that Tip was talking about, for collective investment, who are looking for yield in the long term because they've got a liability. People have been saving, they've got a liability in 15, 20 years' time, and therefore they want governments that stay the course. So I think the test of everything, not only here in South Africa, but I think in Latin America particularly, where there's a massive change of governments with the popularity of left policies, that as long as there is no long-term perceived agenda, even if it's left or it's socialist, as long as it's long-term, because investors want stability, they want to make sure that the return can be paid. It doesn't matter what policy is this, as long as they know what the policy is and it's long-term. So I'll encourage governments and countries to really think that way, that if it's a volatile state, it's a long-term play. So don't change policies every 5 years. Stay the course, so that then we can mobilize that investment, mobilize long-term funding from private sector.
This brings us back, though, John, to conditionality in the first place, where TP highlighted, of course, that collaboration is key amongst the various financing institutions here. I mean, you've got China renowned for offering no strings attached development aid, particularly in Africa, as opposed to the tied or limited aid that usually comes from the development banks or the bilateral deals. How do you see this landscape shifting at the end of the day? Because the Western concern has been that its own development aims, whether it be in the field of human rights, in the field of public health, improved governance as well, will be shot to bits if recipients can get unconditional aid from the likes of China?
Well, I think the experience of the international organizations in extending grants and loans to developing countries with conditionalities has not been terribly successful. To give one example, a condition of extending grants used to be that the recipient country must combat corruption or, if possible, be not corrupt. But there are several instances of countries that received loans in the immediate wake of large corruption scandals. So I think conditionality is actually not all it's cracked up to be. On the other hand, we've got China, which extends loans which are a mix between aid and investment and trade. It's not quite clear which of the three they are, but they seem to work quite well. You do get infrastructure out of them, and the infrastructure remains after China reduces its investment or retires its loan. And I think, therefore, that the Chinese model is actually not a bad one. The onus lies on African governments rather than on funding organizations to create an environment of good investment. And maybe also to just take a little bit of issue with my learned colleague's statement, I think policy stability is important, but I think the nature of the policies does make a difference. In other words, if your policies run counter to property rights or the rule of law, as was the case in Venezuela under Hugo Chavez, for example, then that will affect investment, and it did affect investment in Venezuela, even though his policies were quite stable, but they were not investor-friendly.
So it's the detail in that stability that we have to...
It does make a difference.
I understand, like differ with my colleague, with John here. China, we talk about special economic zone, which are quite different.
Yes.
But the Chinese regime is the most oppressive authoritarian regime, doesn't respect human rights, and capital flows. So I think for me it's longevity. If markets believe that an authoritarian regime will be there for a long time, and there's a Putin full waking back, the money will come in. So I differ, John, there, because we've got examples, whether it's in China, whether in South Korea, during the chaebols. People want stability. If people go to bed with thugs, because it makes economic sense to do that. So we shouldn't shy away.
So we've got two sides of the debate there. Lulu, you're sitting smack bam in the middle, so do you want to referee this one?
Yeah. Well, I think we've learned our lesson in South Africa over the last few years with the mining policy. It clearly sent us a message to say that investors certainly do not like uncertainty. So I agree with Lumkile there in terms of the fact that clarity is required, but I think that what we've seen in Africa is as economies diversify, as they become more open, as it becomes easier to do business, and as there's more clarity and investors' rights are protected in some or other way, the investment did follow. So yes, policy certainty is definitely important, and clarity. But I have to agree with John, if we look at the trends that we've seen in Africa, where there has been a reduction in corruption and governments have become more open and transparent, it definitely had a positive impact.
So
on
playing it
investment.
safe for today.
Sitting on the fence.
Let's bring it back to George over in Kenya. I mean, when the question is asked then at the end of the day, do you see developing countries welcoming the BRICS Development Bank? The answer has got to be probably, George, because it's hard to imagine any of these countries saying no to easy money and on more favorable terms.
I don't think there's any country that can say no to easy money, because there are two things in playing here. One is there is a general failure in the credit markets, and then the second thing is that the intermediation is still very low in Africa. Yeah. Deposit intermediation is very low, and on average terms, the loan deposit ratio in Africa it hovers at around 74%. And if you look at some other non-African developing countries, they're doing in excess of 100%. So there is a general credit failure in the there's a failure in the credit markets that needs to be abridged. The intermediation has to be driven further. And I think, just listening to the conversation down there on governance, I think Africa can grow with all the governance issues we have. What Africa needs to do is, and the leading economies in Africa, what we need to do is to actually eliminate bureaucracy. We just need to move up the ease of doing business ladder by opening up the markets and eliminating. Like for example, in Nigeria, instantly, and yesterday I was reading that it takes between 6 to 36 months, for just oil contracting to be approved. So what we need to do is to actually just eliminate the bureaucracy in the public sector, and we will grow,
Well, of course, bureauccy is a big issue. Red tape issues are big because we get everyone getting pretty tangled up in it all, Mkile.
Yeah, the question here, I think what Bodo is raising is really a very interesting issue for me, because the inefficiencies is because they are distributive. That's why people have them. The Nigerian case, the reason why it's taking so long is because we've got to pay up all the way. And by paying up all the way, you're making other people have access to capital or cash that they wouldn't have. So the reality is that until the incentives are right, you're not going to see that inefficiency going away. So therefore, we stay with the system because we don't have accountability with a system that's inefficient, but actually it's very allocative distributionally. It's efficient. It allocates, it makes everyone in the ladder live well.
Yeah, and that brings us back to what we were saying earlier on, and I can't remember who highlighted it, but the onus then on the countries themselves to actually get their acts together at the end of the day.
Look, this is a very interesting question. Again, these questions we debate all the time at the IDC, at the Development Bank. I was having a conversation again with Iraj Obedian about this, and I asked him a question. I said, is it necessary for absolute political consensus to prevail across the rest of the African continent for the current momentum of economic development to sustain? And we had an interesting conversation, but I think at the end of the day it came down to a perspective that says there are certain countries across the continent which are so big you need them to function for the continent in its entirety to function. South Africa is here. To the east, Mozambique, Kenya and Tanzania need to function in the center. Zimbabwe has to come along and Zambia has to happen. And then, of course, in the east, Nigeria and Ghana and so on and so on. And the biggest elephant in the center is the DRC. And now the question is, why is investment not happening in the DRC? Why are financial flows not happening in a substantive way into the DRC? And I think it comes to a point which, in my view, sort of represents the middle ground between John and Lumkile, and that is that there are certain minimums that are required of countries to be able, even for a mad investor to be able to contemplate investing in that country. Surely there has to be a kind of a political dispensation that enables political players to do so freely and so on and so on. And I think in the second instant, surely there has to be a situation where the citizens of these countries feel safe in their own countries, that they are not subject to constant abuse and harassment by those in power. And once you have that, institutions can be a little bit weak and all that, but you have a workable, I think, environment that investors can be able to live with. And I think probably Ethiopia is an example of that. Certainly under the former president, it wasn't an ideal environment from a democratic perspective. All sorts of problems around certain things, but it had some kind of a level of stability that enabled an investor to take a risk.
Yeah.
Yes.
And that point illustrated as well in what you were saying earlier about China and the way it funds projects, because no matter what your view, their model and their system works. It works for them, and it works for those African countries in which they're doing business.
Yes, and this is a somewhat problematic point for us, because as Good Governance Africa, we promote democracy and accountability, but also economic growth. And we've got the examples of China, Ethiopia, Rwanda, South Korea to some extent, Singapore, quite a number of countries that grew quite well without democracy. We do reserve for ourselves the privilege of being unreasonable and saying that you should have democracy and growth. And so we think that it's not sustainable to repress a country's population in the long term. We also think that China will have to liberalize politically somewhere down the road as the middle class grows, the same in Rwanda, the same in Ethiopia and so on. But certainly there seems to be a stage in a country's development where economic growth can happen in the absence of democratic rights, as long as there's economic liberalism and secure property rights, so appropriate conditions for investment.
And Lulu, that overarching scenario is going to impact the cost of funding, because after that seed capital is put up in the first place, the bank would then, as with the World Bank, aim to borrow from global capital markets by issuing bonds, as we highlighted earlier, and that's becoming a large non-resident borrower within BRICS. But a critical divergence that will display itself between this and the World Bank will emerge in the cost of funding when it comes to these institutions. I mean, the World Bank bonds are AAA rated, given the fact that they are backed or guaranteed by the institutions, 180 member states, and by virtue, you've got a smaller pool of economies here, and we're looking at the ability to guarantee less. So surely this makes things a little bit more tricky, a little bit more expensive in this regard.
It definitely is something that's going to be a concern, especially in the beginning, as this bank try and establish itself and build up a track record. Over time, as investments become more bankable, of course, and the returns are there, and if there's very good governance structures in place and clarity in terms of how decisions are made, transparency for anybody looking at investing, that will all definitely help. But in the short term, I can't see that it will have to be more expensive. And the flip side is that you're actually looking at projects where you would like funding to be cheaper, because it's a bit of a catch-22 situation where this bank will probably find itself in. You would want to see it financing projects at a lower cost than the market rates, because it's not necessarily, it's very often going to be development finance type projects and infrastructure projects that is needed to get economies growing, and you might not initially see the returns. So, and I think I agree with our colleague from Kenya, what he mentioned earlier, to say that that is going to put a constraint on resources initially, because at the end of the day, if the interest payments are higher, then there's less money available.
George, to what extent do these constraints that are propping up, specifically in this initial phase, concern you?
Yes, they do, because in my view, I think initially they will need a seed capital in excess of $200 billion to be able to come to the market, to generate enough liquidity, and by liquidity I mean issuing bonds. It also concerns me that in the initial stages they will be having negative net interest margins, because I would imagine the cost of funding will be a bit higher compared to the lending rates, because if you're talking about coming to the capital markets in Africa, you're talking at yields of 10% and above, especially if you look at ex-South African markets. You'll probably be raising capital at 10% plus yields, and you want to lend these things at very subsidized rates and below market rates, probably below 10%. So initially they'll be running a negative net interest margin. So that's a concern for me.
So that one of the concerns, Lumkile, at the end of the day, what currency will this new bank use?
Well, the currency is very, very clear that the currency that is going to be used comes from the strongest partner, which is renminbi.
The yuan.
So we see renminbi playing a bigger role, and I think as the woes of Europe and America continue, it continues to prop up the Chinese currency. So I'm seeing really a situation whereby we have now to start talking seriously within the multilateral institution about that currency, because that discussion did come up in Korea, the G20, and we just need to put now also the building blocks of a third currency called yuan or renminbi that will use it in the third currency, which in fact will probably be a currency of value for all developing countries, given the strength of the balance sheet of the Chinese.
Does that not deepen the unease about China's or outsized role?
What about the euro? What about American dollar? I don't care. As long as that currency is liquid enough, is accessible to all the countries, and the back of that currency has got a very strong balance sheet, I'm fine. But if it's like the American balance sheet, the European balance sheet, I'm very, very, very worried. That's why we need to move very quickly to make sure that the rules are there within the monetary institution, that now we've got three currencies, we've got a renminbi, we've got a dollar and a euro.
Talking about moving very, very quickly, we've got reports, TP, suggesting that the BRICS countries aim to complete preparations for the bank in time for the 2014 BRICS Summit. Is that a feasible timeline in your books? Or are we being a little bit too over-optimistic?
Yeah, look, what I do know, and I think this is also known to all of us, is that the finance ministers of these countries and their teams in their treasuries are working around the clock to do what is necessary in order to create the institutional framework and to define as much detail as possible. But putting together an institution of this magnitude and of this scale is not easy. But I think what we should ask ourselves next time in Brazil is whether what they will be putting on the table is so substantive enough that it gives confidence to the citizens of these countries that there is significant movement going forward. So the challenge really is not whether they have created some organizational structure and appointed a CEO. The challenge is whether there is enough substance around issues of capitalization and issues of currency and so on and so on, which relates to the governance of this institution. And given what I've heard from our own Minister of Finance, they are very serious about this. And the teams are working very hard. DBSA as well, I think the IDC as well, we also have representatives that are part of the thinking team in putting this together.
So, John, after that comment, after the conversation we've had over the past hour or so, is the BRICS Development Bank a done deal? Because some say not necessarily. There's just too much that needs to be thrashed out.
I think, as usual in complex cases such as this, the devil is in the detail. But I also think that the stakes are very high. It's very important for the reputation of the BRICS to get this right. Particularly considering that during their first 5 years of summits, they didn't actually do anything except meet. So this is the first substantive initiative that's coming out of BRICS, and for that reason it's very important for the BRICS to get it right and make it work.
Well, a good place to leave it. Thank you all for having joined me this morning. We've come to the end of this edition of the IDC Dialogues. Thanks to my guest, Lumkile Mwandi, who's Chief Economist at the IDC, Tipin Chocho of the DBSA, John Endres of Good Governance Africa, Lulu Kruchel from KPMG, and then, of course, George Bodo, head of the financials desk at EcoBank Research, who joined us from our studios in Nairobi, Kenya. Until next time, from me, Alicia Seckham, it's goodbye.